Hey everyone, we are already in Q2 result season. And if you look at the September results so far, one thing is clear. The real winners have started to stand out. Despite global uncertainty, market volatility, and slowdown in some sectors, a few companies have delivered exceptional Q2 performance. So in this video, we'll look at 5 such companies that have reported stellar Q2 results so far. These companies are not only growing fast, but are also expanding margin, gaining market share, and strengthening balance sheet. Interestingly, each of these businesses represent a different sector. But one thing common across them is execution excellence and long-term compounding potential. Alright, let's get started. So first company in the list is Ami Organics, that is now known as Acutaas Chemical. In latest Q2 result, company's revenue has jumped by 24% year-on-year and net profit has grown by 94% year-on-year. Now Ami Organics, that is Acutaas Chemical, is a leading R&D driven manufacturer that is focused on development of advanced pharma intermediates and specialty chemical. 85% business is from advanced pharma and 15% from specialty chemical. It is a high growth company with 33% CAGR growth in revenue in last 5 years and 41% CAGR growth in profits. The reason for higher growth in profit as compared to revenue is due to consistent focus on complex high margin chemicals that has resulted in company's operating margin growing from 18% in 24 to now at 27%. It has been reflected in company's share price that has doubled in last 1 year and grown more than 3 times in last 3 years. Interestingly, company's management continues to guide for 25% revenue growth in FY26 with margins in the range of 28 to 30%. So there is still further scope for margin expansion. If you are following this channel, we have discussed Acutaas Chemical multiple times in the past. The most interesting part about Acutaas Chemical is that while pharma intermediary business is very robust and steady, company has entered into specialty chemical for performance material and electronics intermediates that are used in semiconductor, display material and battery chemical. In the latest con call, management mentioned that on semiconductor chemicals, we have a couple of products that are expected to move into commercial scale production. While these products are still small in terms of overall revenue contribution, they represent an important milestone, a clear sign that our earlier efforts in this space are beginning to materialize. We believe that in the medium term, our semiconductor portfolio will broaden further to become a meaningful growth driver for the company. Together, these two verticals, battery chemical and semiconductor, will serve as an important growth pillar for us alongside our CDMO business, where we are witnessing a healthy increase in customer inquiry and new molecule addition in our CDMO pipeline. Due to company's fantastic past growth and future visibility, it has resulted in continuous increase in shareholding by both FIs and DIs, and public holding has consistently reduced from 50% to now at 27%. Currently, company commands a market cap of around 14,000 crore with a PE of around 60. Considering the growth in revenue and profit, company will command a premium valuation. Now, before we move to the second company, there's something that I personally find extremely useful as an investor, especially when it comes to managing and tracking my overall portfolio. I've always liked using Dezerv to get useful insight on my mutual fund portfolio like exit recommendation, benchmark comparison and much more. Now, as an investor who is invested across multiple instruments, there's still one problem I used to face a lot: tracking all my assets spread across too many different apps and platforms. This problem has been solved now by Dezerv, as they've launched the capability to add and track other assets like FDs, bonds, NPS, REITs, AIFs on their app. This helps you monitor your overall wealth in one place. Dezerv app is extremely useful for investors who want to get an understanding on how well their portfolio is performing and monitor the overall portfolio value. You can download the app by clicking on the link in the description. Now let's move on to the second company with another exceptional results, and that is Laurus Lab. In latest result, company's revenue has jumped by 35% year-on-year and net profit has exploded by 883% year-on-year. Now it has been a roller coaster journey for Laurus Lab in last 5 years. During COVID phase, Laurus Lab financials grew exponentially and it became market's darling. But then things slowed down. Margin fell, ARV demand collapsed and company invested in capex. As a result, its margin shrinked and profit tanked. It resulted in sharp fall in company share price and people started calling it bogus lab. However, starting 2025, the growth is back on track. Okay, let's be very honest, Laurus Lab is not an easy business to understand. First of all, pharma itself is very complex. On top of this, Laurus Lab is involved in 2 different businesses. First is generic APIs and formulation, where they make active pharmaceutical ingredients, that is API, and ready medicines for large global pharma players, especially in antivirals. Second segment is CDMO, that is contract development and manufacturing. This is the most exciting phase where Laurus Lab helps global innovators develop and scale their new molecule. This business has high entry barrier and higher margin. But the catch is, CDMO is a very lumpy business. There can be a phase when there is high demand and revenue and profit shoot up. And then you find quarters where growth is missing. That said, CDMO is a massive opportunity for years to come. So you have to look at Laurus Lab business from a long-term investing lens. Now this slide gives a good clarity in terms of company business breakup and contribution. In H1 of FY26, CDMO contribution is 32%, which is up by 7% versus last year. Generic API contributed 39% and generic FDF contributed 68%. Its CDMO division revenue is up 74% year on year. So that is the main contributor in company's growth. Generic revenue is up by 20%. Now the big question is, what next? Can Laurus continue to scale at fast rate? So in the last 5 years, Laurus Lab has invested around 4,000 crore in capex, and this investment would continue to reap the benefit in coming quarters. Plus, company has announced allotment of 532-acre land, which is 2 times bigger than existing land infra. And there is around $600 million, that is around 5,000 crore of capex proposed over the next 8 years. While management has not provided any specific guidance, they have clearly mentioned that FY26 would continue H1 momentum. There is robust CDMO outlook and underlying EBITDA margin are expected to be higher, driven by better asset utilization and product mix. Now next 2 stocks in the list are from IT sector. This is especially interesting because Indian IT sector is struggling for growth due to global uncertainty. And many people think that the rise of AI can kill Indian IT industry. But there are 2 companies from mid-tier IT segment that are performing exceptionally. First is Persistent System. In latest Q2 result, company's revenue has jumped by 24% year on year and net profit has grown by 45% year on year. Second company is Coforge. In latest result, company's revenue has jumped 32% year on year and net profit has jumped by 76% year on year. And this is not the first time when Persistent and Coforge have outperformed. Look at Persistent last 3 years of data. Both its revenue and profit growth is super consistent with 28% CAGR growth for revenue and 27% CAGR growth for net profit. In fact, you look at 5-year or even 10-year, Persistent is true to its name, one of the most consistent performer across business cycle. No wonder it has been a huge wealth creator for the shareholders. Coforge on the other side is also super consistent in revenue growth with 23% CAGR rate in last 3 years and 24% CAGR rate in last 5 years. Net profit growth has been a bit volatile, but in last 10 years it has compounded at 18%. Trailing 12-month profit growth is exceptional at 39% rate. As a result, it has also created a lot of wealth for the shareholders. The big question here is, when large cap IT companies are struggling for even double-digit growth, how Persistent and Coforge are growing leaps and bounds? Answer is agility. IT sector is all about technology adoption. How quickly you adapt to new technology and build capability decide how fast you grow and what margin you command. For large cap IT companies, it's not easy to pivot because they are huge giants with diversified business. It takes time for them to adapt to changes. On the other side, mid-tier IT companies like Persistent and Coforge were able to adapt faster with emerging technologies around digital sector. Both companies have built niche in high demand verticals. Coforge focuses on travel, BFSI and insurance where tech spending has revived faster. Persistent dominates the cloud, product engineering and AI-driven platform. These are the areas where clients still invest despite budget cut. So even though the overall IT market slowed, these 2 companies found pockets of growth. The best part is, while Persistent and Coforge are relatively small enough to be agile, but large enough to handle global scale projects. But of course, because of high growth in the past and strong capabilities for future growth, both companies command a premium valuation. The good thing is, due to weakness in IT sector, both companies have consolidated in last 1 year. That has resulted in some cool off in valuation. I strongly believe that Indian IT sector would continue to grow. It's just a matter of time. AI is only going to create more opportunities for IT companies because the world would need IT engineers to deploy AI across domain, and India is the only place that can provide that talent at scale. Hence, I believe that these companies have a long journey ahead. Fifth company with exceptional Q2 performance is TVS Motor. Company's revenue has jumped by 24% year on year and net profit has exploded by 42% year on year. TVS Motor is a classic example of how a competitor becomes a leader. A decade ago, if someone mentioned Indian two-wheeler sector, you would think of Hero MotoCorp, Bajaj Auto or Honda. TVS was at 4th position, respected but not aspirational. Fast forward today, TVS Motor is not just catching up, it is leading the new era of mobility. From premium bikes to scooter and EVs, TVS has outperformed even legacy peers across both sales and shareholding return. In last 5 years, company sales has compounded at 19% CAGR rate and profits have compounded at 27% CAGR. In 3 years, revenue and profit growth is even higher at 22% and 41% CAGR respectively. As a result, TVS Motor continues to create wealth for its shareholder year after year. Basically, 3 factors have resulted in exceptional journey of TVS Motor. First is product premiumization. Earlier, TVS was known for mileage bikes like Star City or Victor. That time, margins were low and brand recall was limited. Then came Apache series. Then it launched Raider. It resulted in sharp jump in average selling price that resulted in margin improvement for the company. Then, TVS also catered to Indian scooter market that was once dominated by Honda Activa. It first launched Goody Pap that mainly catered to female segment. But then, it launched Jupiter, a complete family scooter and ride competitor to Honda Activa. Within 2 years, Jupiter became India's #2 scooter brand. Second factor is the iQube revolution. Its iQube scooter is among the top selling EVs in India behind only Ola and Ather. And unlike startup, TVS makes profit. They are not chasing volume blindly. TVS focus on customer experience, quality, reliability, leveraging its dealer networkship. That strategy has made iQube one of the most trusted EV brands in India. Now the company is preparing for a full EV portfolio from entry scooter to high-end performance bike. Third factor is global expansion. Very few people would be aware that 25% of TVS business comes from export in Africa, Latin America and Southeast Asia. So the growth is not just from domestic market but from across the world. And all these factors would continue to fuel the growth in TVS Motor in coming years. As far as valuations are concerned, it certainly commands a much more premium valuation as compared to its peers. But it is also a fact that TVS has outperformed its peers in terms of growth by a big margin. Obviously, it will command a premium valuation. So in this video, we discussed 5 companies that truly stood out so far in Q2 FY26. And if you noticed carefully, they are not random names. Each company is a category leader in its own domain. Acutaas Chemical, riding on high margin specialty chemistry and semiconductor opportunity. Laurus Lab, after a rough phase, now benefiting from its bold CDMO bets and capacity investment. Persistent System and Coforge, proving that agility and innovation matter more than the size in the IT world. TVS Motor, the perfect case study of how a legacy brand can reinvent itself through premiumization, EVs and global reach. So the broader message here is simple. Markets may stay volatile, but business with strong fundamentals and execution focus always find a way to deliver. Of course, valuations for some of these names are on higher side, but quality always comes at a premium. The best part is, these companies are not delivering one-off result. They are consistently outperforming quarter after quarter. And considering the growth opportunity, there's a long journey ahead for them. Now you tell me in the comments, which company from this list you find most promising? And did I miss any exceptional Q2 results so far? Let me know in the comments. If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care. The views and opinions expressed are my own and does not reflect or represent the views and position of Dezerv Investment Private Limited or its affiliates. The information contained in this video is for general and information purpose only and is not meant for advisory or recommendation purpose.